Hi guys, I'm Nicola McKenzie, founder and mortgage advisor here at Dun & McCarthy Mortgages. In today's video, I'm going to be giving you reasons why a fixed rate mortgage can sometimes be a bad idea, contrary to popular belief. So if you want to find out why, then stay tuned. Now guys, there are many benefits to a fixed rate mortgage, and that is why they tend to be the most common type of mortgage product that people opt for. Most people want certainty over their monthly payments. They don't want any surprises or as little surprises as possible, and that's often why they opt for a fixed rate mortgage. And guys, a fixed rate mortgage can be great for many people. This video isn't about slating fixed rate mortgages, so please don't misinterpret it as that. The point of this video is because I want to highlight that there are some instances where a fixed rate mortgage isn't the best idea. Now, let's just say that you had two mortgage products. Let's say that you had a fixed rate mortgage, hypothetically speaking, it was 1%, and you had a variable mortgage and it was at 1%. Which option would you go for? Most people would probably opt for the fixed rate mortgage at 1%. However, a fixed rate mortgage, or choosing the right type of mortgage, shall I say, for your situation, is not just about the interest rate. What we also have to consider when we're looking at the right product for us is the flexibility options that come with that product. And one thing that most, not all, but most fixed rate products are not, is flexible. Now, the first point that I also want to talk about is the fact that fixed rate mortgages are often more expensive than variable options. Again, not in every case, but often they are a more expensive option. Now, not only is a fixed rate mortgage often more expensive than variable options, but generally speaking, the longer you fix into a mortgage, so if you're on a 5-year fixed rate, for example, that's usually going to cost you more than a 2-year fixed rate in terms of interest rate and monthly payments. Therefore, you need to weigh up if paying more initially is worth it. So again, if you, let's say, have lots of disposable income and you can afford to deal with small fluctuations in interest rates, then it might be, depending on what the cost saving is between a variable rate and a fixed rate mortgage option, it might make sense to go on a variable rate product. Because if you're tied into a 5-year fixed rate and rates drop, you can't generally just switch product without encountering what's known as an early repayment charge. And I'm going to talk about early repayment charges in a moment. So certainly in an economic climate where rates are reducing, a fixed rate mortgage can sometimes not be the best option. Now, what I'm going to do is talk in detail next about the flexibility of fixed rate mortgages, or shall I say the inflexibility of fixed rate mortgages. Now, when you enter into a fixed rate mortgage deal, it's likely that it's going to come with what's called early repayment charges. Now, I say likely because not every single fixed rate mortgage comes with an early repayment charge, but 99% of them do. Because as a trade-off, if you like, for fixing your payments and having certainty over them, the bank wants to know that you're sticking with them for a certain period of time. Now, these early repayment charges are usually applicable if you want to repay some or all of the mortgage before the product expires. So for example, if you're tied into a 5-year fixed rate, then usually the early repayment charges, the penalty for you coming out of that 5-year fixed rate, is usually applicable for 5 years. And most banks, again, it does vary depending on the lender, but a typical example of how an early repayment charge works is that on a 5-year fixed rate product, if you exit the product in year 1, you'll pay 5% of the balance, year 2, 4%, year 3, 3%, and so on and so forth. So if you're taking, let's look at a mortgage of £500,000, that is a £25,000 potential penalty in year 1 of you exiting that mortgage, 20k in year 2, 15k in year 3, so on. So you need to be as sure as certain that your circumstances are not going to change for that period of time that you're tied into. Because if something changes in your circumstances that might mean that you want to come out of that mortgage deal, then that could really sting you. Now, when you're looking at variable options, it's more often that you would find a variable mortgage or a variable rate mortgage without early repayment charges when comparing it to a fixed rate. So with that in mind, they are generally more flexible. So depending on what your goals are, short term and long term, that is going to really help you to determine what the most suitable product is for your situation. It's not possible to say a fixed rate mortgage is a best type of mortgage for everybody, because even in a market where rates are rising, a fixed rate mortgage still may not be the best option. It's about your individual circumstances. And as I said, we can work with you to help you weigh up the pros and cons of both to work out what's best. Now, if you are watching this video, then I assume that potentially you're looking to buy a property using a mortgage, move home, or review an existing mortgage. Now, if you trust the content on this channel and you've been finding it valuable and useful, then imagine the value that you would get from us helping you with your own mortgage. Now, here at Dun & McCarthy Mortgages, we help to guide you through the house buying process and find you the best mortgage deal, give you advice throughout, and make sure that you're not making any costly mistakes through the house buying process as well. Now, we're here to help you get the best mortgage deal from thousands of products from lots of high street banks and building societies, as well as specialist lenders as well. Compare all of your options to find you the best deals. Now, head over to our website, dm.mortgage, and book in for a free of charge appointment today. We can help you no matter where you're based in the UK, and we can give you your options and provide you with advice so that you know exactly where to go and what to do next. And of course, if you're finding this video useful up until now, then you need to hit that subscribe button and the notification bell so that you never miss a future upload. But now let's get back to the video. Now, my next point also ties into flexibility as well, but it's really about a fixed rate mortgage. Like I said, generalising, likely is going to come with those exit charges, as I explained. A common mistake that people make is that they're considering moving home, or like I said, doing renovations, and they tie in to a fixed rate product. The longer the tie in, usually the more problematic. But this is potentially one of the worst things that you could do, because, and again, a lot of this depends on the circumstances of the move. So I'm not saying if you're moving home or renovating, a fixed rate is categorically always a bad idea, but a lot of the time it can be. Because depending on your time scale of when you're moving house, if you're tied into a fixed rate, then like I said, the early repayment charges are going to apply if you want to potentially move home. Now, if you want to move house and you want the flexibility of having all the lenders or more lenders than just the one you're currently with available to you, it may not be your current lender that's offering you the best deal to move house or raise capital to do those renovations. So let's say that when you took the mortgage out, you were employed, and now you're self-employed, but you've only got 1 year's worth of accounts. Most banks will ask for 2 years plus worth of accounts if you're self-employed. There are some banks that might accept you on 1 year's accounts, but if you're tied in with a bank that needs 2 years accounts, then that bank isn't going to accept you to raise that capital potentially, or to move house and borrow more money from them. And if you're tied into a fixed rate deal, you've then got two choices. Do you wait out the end of the fixed rate deal until you've got that second year accounts, or do you pay that hefty early repayment charge? Whereas if you hadn't have gone and tied into a fixed rate deal, let's say that you'd gone into a variable mortgage, but let's say that you'd gone onto the standard variable rate when your last product expires. So even though the standard variable rate can often be higher in terms of the interest rate that the bank charges, but it doesn't come with those heavy exit fees. So therefore, it's going to be a more flexible option. And if you know that you're moving house a month or two after your current product expires, then that might be a more sensible option and route to take. Now, I spoke about going on to the standard variable rate, and actually, contrary to what I just mentioned, again, depending on the timescales of the move and what the circumstances are around the potential move, then actually it might be not necessarily a standard variable rate, but it could be an alternative flexible option that's offering a low interest rate and a fee-free competitive product that still doesn't come with an early repayment charge. But often that type of product is not a fixed rate, which means that then when you do decide to make that house move, you've not got the hefty early repayment charges, and also you've not had to pay out extortionate amount in product fees, but you've also potentially managed to escape going on to the standard variable rate, which is often quite higher in terms of interest. Now, my next point, again, is still related to the flexibility point that I originally raised. When you're planning significant renovations on a property, what's likely to happen? The value of the property is likely going to increase. And depending on how significant those renovations are, that could be quite a significant increase. Now, what comes with an increase in the value of your property is a lower loan to value. So the loan to value is your mortgage amount expressed as a percentage of the property's value. Banks will reward you for having a much lower loan to value, and they will typically give you lower interest rates. Now, if you're stuck in a 5-year fixed rate product and then you carry out these hefty renovations on the property within, let's say, 6 months, then because you're tied into that product, you can't just switch to a better rate based on this new loan to value that you've accrued because of those renovations that you've done. So again, depending on how significant the renovations are and the timescales that you're looking to do them within, if you were to consider a more flexible option that doesn't come with an early repayment charge and likely is a variable mortgage, or a variable rate mortgage, then that's going to mean that you could do the renovation and then switch to a fixed rate product and tap in to the greater amount of equity that you've accrued since doing those renovations. Now, if you're considering paying some or all of your mortgage early, then again, on the basis of the fact that most fixed rate mortgages are going to charge you early exit fees, then it might be that temporarily going onto a more flexible type of mortgage, usually a variable interest rate, is going to be a better option. Again, now this is going to depend on how quickly you're looking at paying off that mortgage, what your plans are and the circumstances are around that early repayment. Now, with that said, a lot of fixed rate mortgages are not completely inflexible when it comes to making overpayments. Often fixed rate products do allow overpayments up to a certain amount. You have to check by the lender because it does vary. But ultimately, if you're looking at making quite a significant overpayment, then that is likely going to affect you if you're tied into a fixed rate mortgage in terms of early exit fees. So again, that's another example as to where tying into a fixed rate mortgage may not, depending on your timescales and goals, be the best option for you. Now, we deal with high street lenders and specialist lenders to compare lots of different banks from thousands of products to get you the best deals. So book in today for that appointment and make sure, of course, that you subscribe to the channel and hit the notification bell so that you never miss a future upload. And I will see you in my next video.